Public debt and monetary policy. The complex dance between debt financing and monetary policy. 1. Introduction to debt financing and monetary policy interaction. The intricate relationship between debt financing and monetary policy is comparable to a choreographed dance, a performance where each step influences the economic flow. From debt issuance to adjusting interest rates, this delicate interaction shapes everything, from government spending and investment to inflation and consumer behavior. As one of the most critical aspects of financial and monetary policy, understanding this relationship helps decode the very pulse of the global economy. Debt financing basics. Debt financing allows governments and corporations to borrow money today with the promise of repaying it in the future. This borrowed capital is used to fund operations, investments, or public projects. Various methods, such as issuing bonds, selling treasury bills, or taking out loans, provide immediate access to resources. Consider a government that needs to build infrastructure like roads, schools, or hospitals, but lacks sufficient funds. By issuing bonds, it mobilizes the necessary resources, betting on future economic growth to repay its debts. 2. How debt financing and monetary policy interact. The true complexity emerges when debt financing and monetary policy interact. For instance, when a government engages in large-scale borrowing, the demand for money can increase, driving up interest rates unless the central bank intervenes. Central banks, in turn, must react to these movements to ensure balance in the economy. Global influences and investor sentiment. The relationship between debt financing and monetary policy extends beyond domestic borders. Global financial markets, investor sentiment, and international economic conditions all play crucial roles. If investors perceive heavy government borrowing as unsustainable, they may sell off government bonds, raising borrowing costs and destabilizing the economy. Central banks must navigate these global pressures while remaining focused on their domestic objectives. 3. Inflationary pressures and interest rates. Understanding the interplay between inflation and interest rates. Inflation and interest rates move in tandem, much like the push and pull of ocean tides. Inflation represents the gradual rise in prices over time, eroding the purchasing power of money. Interest rates, set by central banks, serve as a counterbalance, determining the cost of borrowing and influencing spending behavior. Together, they shape the economic landscape. Causes of inflation. Inflation can be driven by several factors. Supply-side pressures, such as increased costs of raw materials or labor, can lead to price hikes. Alternatively, demand pull inflation occurs when the economy grows too quickly, driving demand for products and services beyond what suppliers can provide. The role of interest rates in managing inflation. Interest rates are a powerful tool for central banks to manage inflation. By raising interest rates, borrowing becomes more expensive, which slows down spending and investment. Conversely, lowering interest rates encourages borrowing, stimulating the economy. 4. Interest rates and inflation. A delicate balance. Central banks often increase interest rates to combat high inflation. However, this decision is not without its side effects. Higher interest rates can stifle economic growth by discouraging borrowing and reducing consumer spending. The challenge is finding the right balance that cools inflation without triggering a recession. Global ramifications of interest rate changes. In today's interconnected world, changes in interest rates in one country can have far-reaching effects. For example, if a major central bank, like the Federal Reserve, raises interest rates, it can affect global investment flows, currency exchange rates, and international trade. Countries with lower interest rates might see capital outflows as investors seek higher returns elsewhere, leading to currency depreciation and economic instability. Equity and public policy implications. Inflation and interest rates do not affect everyone equally. Lower-income households often feel the effects of inflation more acutely, as they spend a larger share of their income on essentials like food and housing. Properly managed interest rate adjustments can promote a more equitable economic environment, ensuring that inflation doesn't disproportionately harm vulnerable populations. 5. The ongoing challenge. Managing the interaction between inflation and interest rates is an ongoing challenge for central banks. They must continuously monitor economic indicators, anticipate inflationary trends, and adjust policies proactively to ensure steady economic growth without letting inflation get out of hand. Quantitative easing and public debt. What is quantitative easing, QE? Quantitative easing is a monetary policy tool employed by central banks during periods of economic downturn. When traditional methods, like lowering interest rates, become ineffective, QE allows central banks to inject liquidity into the economy by purchasing financial assets such as government bonds. How QE works. Central banks create new money electronically and use it to purchase government bonds, which in turn lowers borrowing costs. By increasing the demand for bonds, QE pushes up bond prices and lowers yields, making borrowing cheaper for households, businesses, and governments. Effects of QE on public debt. One of the key benefits of QE is its ability to lower the cost of public debt. When interest rates fall, governments can borrow more cheaply, making it easier to finance budget deficits without resorting to austerity measures. However, this comes with risks. 6. Long-term risks of QE. While QE can reduce borrowing costs in the short term, it can also encourage governments to take on excessive debt, potentially leading to unsustainable debt levels. When QE is scaled back, interest rates may rise, increasing the burden of servicing public debt. Inflation and QE increases the money supply, and if the additional liquidity stimulates demand without a corresponding increase in supply, inflation can rise. While mild inflation can reduce the real value of public debt, uncontrolled inflation can destabilize the economy. The global impact of QE in major economies like the United States or the European Union can have ripple effects across the globe. It can lead to currency depreciation in emerging markets, disrupt international capital flows, and affect global trade dynamics.